Just like to welcome you to our recorded version of last week's volatility call. So what happened? Behind me you can see the graph of the US S&P 500 and you can see a 10% fall there that happened over 2 days. And similar falls were felt on the Australian market falling from about 6,100 points down to 5,800 points in a very short time frame. What did we see in the media? Of course, you're going to see massive stories of huge billions, trillions of dollars being lost on global share markets. The bull market is over. The volatility spells out bad things for you. So what actually happened? The US reported last week that jobs growth exceeded expectations. Also that wages growth in the US were growing particularly strongly. Does it sound like positive news? Absolutely, that was positive news. And we've reported for a long time now about how positive things were in the US. Our economic updates also pointed to things were so positive that we thought global markets were being very slow to price in US interest rate rises. And I've actually been making that point for about 18 months now. So last week's volatility and global share market falls in some markets of up to 10% were the market properly starting to reprice in the fact that we think a lot of interest rate rises, and not just in America, around the world, are on the way. What sort of effects will that have? What are the effects of rising interest rates? Well, obviously, businesses that borrow money will have bigger interest burdens to service over time. And also, future cash flows and earnings of businesses always need to be discounted back to today's value for us to develop a price target. So as the discount factors for those future cash flows and earnings increase, it makes some of the shares less valuable today than they were at lower interest rates. So what do we make of all this? This is a natural part of share markets. And I've explained before, you can see some very long-term charts behind me. They go for about 35 years back to 1980. That is the Australian stock market over 35 years. One just shows capital growth. That's been well over 800% in 35 years. And the other one, just on my shoulder here, that's the Australian share market inclusive of dividends, up at all-time record highs. And the recent falls in the market hardly make a blip in the radar. And this is what we see this. This is a blip in the radar. It's nothing for you to be concerned about. Now, living through those beautiful 35-year graphs where it seems like a straight line with a few bumps in it, on shorter time frame, those bumps are bigger. Some of the graphs behind me come from the 1980s. Some of the graphs behind me come from the 1990s. Some of the graphs behind me come from 2011, 2012, 2014. The first thing I want you to understand is in those 35 years, to get those beautiful smooth charts, there have been 22 falls of 10% or more. 22 falls of 10% or more. So this is just natural movements in markets. The other thing to understand is where those 10% falls happened and they weren't followed by a global recession or a recession event, share markets bounced back by a minimum of about 18% as we moved through the next 12 to 18 months. Indeed, in some time frames, those bounce backs were more than 35% over the next 12 to 18 months. So understand natural market movements over 35 years do entail some share price falls in the stock market, and the bounce backs that come through, if they're not a recessionary event, are always larger. So we feel that there is nothing for you to worry about because our economic updates focus on the global economy and how it's going, and at the moment we only see positivity. That news coming out of the US, that large amounts of jobs growth, that large amounts of wages increase are only positive for business, only positive for GDP, only positive for company earnings, and only positive for company dividends. Now, in the past, we always look at, in our economic updates, volatility in the market. You can see the charts behind me. Volatility is normal. If you could read those little reasons that mark every bit of volatility, maybe it's Brexit, maybe it's a Greek bond crisis, maybe it's the election of Donald Trump. Volatility and market knee-jerk reactions are a natural part of markets. And I do talk about here, there is this link to one of my volatility calls that's about 20 minutes long that explains volatility in a lot of depth. If you can get comfortable with volatility over time with education, you can take advantage of it and you can make money out of it. Volatility allows you to buy good businesses at better prices than would otherwise be available. Back to the economic update, we always, in our good, the bad and the ugly analysis, look at particular points or factors that are coming up that may cause some volatility in markets. And there are always a large number of positive things happening out there and always a large number of potentially negative things. Under the bad, you see the global credit cycle tightening catch-up begins. This is what interest rate rises are all about. Interest rate rise expectations in major economies like the US, like the UK, and even with a lag effect coming through here in Australia, do need to be properly priced in, and don't think that that has fully happened yet. Don't be frightened or afraid of that. There is going to be more volatility to come. But we will always educate you up in that in our quarterly economic updates, which is why we encourage you to listen in and tune into them when we put them on. Also understand from the economic updates, we always give you a fundamental view on what we think is happening and actions that you should take. And in our Treading Carefully fundamental view from our December economic update, the era of cheap credit is over. And this will cause more volatility in the markets going forward. And we certainly haven't seen the last of that. Also, our tactical recommendations, please read through those carefully. We believe that these will apply to every investor. But once again, be opportunistic. If we keep some cash levels available for these volatile periods, we will be able to buy good investments and good businesses at better prices. Please understand too that this particular volatile period is where your planner or asset allocator really earns their money. It's a very, very important part of your financial future that you have your investments asset allocated. The corporate floating rate fixed interest notes over this period did not move in price at all. The other thing that did not move over this period is your income. The price of an investment or security or fixed interest note has nothing to do with the income that you get paid. Those prices can move down. That does not reduce your income from them. So asset allocation is very important. You should explain your feelings towards the recent volatility to your planner or asset allocator. It's a very, very important part of building your financial future. And certainly a very important part of what your financial planner does for you. Also, in our next economic update due out in March, there is a large change, and that change is we have moved into the next phase of the cycle. We've always reported with this chart below us. It's always been in that defensive sort of bottom left-hand corner. We've moved up to the top left-hand corner now. And this has great implications for what is happening out there in global markets and how you can take advantage of that. So for some time, moving up into this corner chart is going to cause bond yields to rise and bond prices to go down. We don't have you exposed to fixed rate bonds. This is why we were always in floating rate corporate notes, which, as I said, over this period, the prices did not move and the income has not changed. Also recognise that moving up into this growth phase quadrant is going to cause a lot more volatility in the prices of investments. Volatility has been very low for the last few years. It might not feel like it, but it's true. We will have more volatile movements going forward as we're now in the growth phase of the economic cycle. Every economy is growing at its best clip since about 2006. Very positive times for business, very positive times for investments. We'll have more about this in our March economic update for you. Just reiterating the market outlook for 2018 in terms of economic growth, business growth, services growth looks very positive. There hasn't been this positive for about 12 years. This is a good time to be invested. Don't let this recent volatility shake you away from your actual financial plan. It's time to stick with it. It's going to be a very positive phase. We will have more information on how we take advantage of this in the March economic update. Make sure that you tune in. We're going to have more updates on globally what we're expecting. We're going to have updates on changes in the credit cycle. Please look for that, but understand that this is the time, this growth phase, this cyclical growth phase, we've already prepared you for. But there will be investments that will struggle in this upcoming growth phase. The utilities, the bond proxy infrastructure stocks, the bond proxy like property trusts that have been very good investments in the past will struggle in this phase of higher bond yields and higher interest rates. Other cyclical businesses that are involved with services in the economy, that are involved with mining and resources and energy, that are involved in technology, they're going to do very well. But in a great part, we've already prepared you for this, and your asset allocation is your best protector against some of the volatility coming up, and also giving you opportunities for your capital to grow as well. If you want to see the last December economic update where we introduced a lot of this information to you, you'll see right here, if you log into that, you'll be able to watch it. You can refer back to your notes. Probably a good idea too to go 4 or 5 economic updates back. It'll give you a very good picture on global bond yields and what that means for your investments and why our strategies led us to floating rate corporate notes that have performed so well for you. Finally, just the 10 commandments that we should always follow during these volatile periods. Stay calm. This is normal. This has happened for 35 years and this will happen again. That's not a bad thing. You've got a financial plan, you've got a financial future that is going to go for quite a few years yet. So this is not the time to panic. This may be the time to take advantage. Recognise the media is there to sell advertising space, and all those lines of billions of dollars lost and things like that are just grabbing your attention to sell advertising space. They're not giving you any meaningful information. If you go back to our economic update, the Deputy Reserve Bank Governor says he watches no media. That's the value that he places on that. Also be aware we want to stay focused on global fundamentals. That's why the economic updates are so important, and also understand your income has not changed over this period. Stay well diversified, stay in touch with your asset allocation, communicate your feelings to your financial planner. This is where they really earn their money. I look forward to joining you on our next economic update in March.